So, here we are at the Capital Club at the end of the Economist Corporate Network oil market briefing, for which I'm delighted that we were joined by Cailin Birch, the global economist for the Economist Intelligence Unit from London. And she's joined us today to talk about the oil price and the factors which are impacting on the oil price, both supply and demand, and the many political factors. So, Cailin, if I might turn to you now and ask you what you think is happening to the oil price, what is our oil price forecast for the next 5 years, and what are the risks to our forecast?
Well, oil prices obviously have been volatile in the last, that's probably something that's natural to the oil market, but especially in the last 6 months. We have lots of risk on either side, pushing oil prices up and down, but as a result, they kind of are stuck in this band of $60 to $70 a barrel, and we think that's probably going to continue. So quickly, the EIU forecasts oil prices by looking at supply and demand fundamentals, who's producing what, and how is the global economy going to perform, what does that mean for oil consumption. They have to layer on the wild card events. So is the US and the Iranian government going to go into a sort of confrontation that then disrupts the oil market outside of that? Are the US and China going to face off in their trade war to an extent that both economies suffer, and then the oil market after that? And then examples of kind of extra wildcards, like will climate change the trajectory for oil consumption in the next 5 to 10 years? What we're really thinking about now, the factors we think are going to keep oil prices in that range are, one, again, the US and Iran, and the tensions generally in the Middle East. We've seen a big escalation in rhetoric under the Trump administration against Iran, new sanctions, etc. But oil prices haven't really responded. The latest attacks that happened on 2 tankers in the Gulf only saw oil prices rise by $2 a barrel, 60 to 62. That's not the end of the world. What that tells us is the more important factor is on the demand side, and the fact that President Trump is really pushing as far as the US is willing to go for now against China in an ongoing trade war. China's responding with just as much resolution, I think. And we have a moment at the end of June when the 2 leaders are due to meet on the sidelines of the G20 that could help us to at least call a pause in the trade war if we think that will happen. If it doesn't happen, you would expect oil prices to fall to the bottom end of that range and possibly even lower as both US and Chinese economic growth are hurt.
Great. So if we're expecting then oil prices to be range bound between 60 and 70, what's really stopping it going above 70, and what's really going to stop it falling below 60 in our mind?
Falling below 60, that's when we start to see the US becoming unprofitable. So at the moment, in terms of WTI prices, the US can operate at around $50 a barrel and be profitable across most regions. That's equivalent to about $60 for Brent international price, and that's where we are now. So US producers are doing well. The ones who are more cost effective, and there are a lot in Texas, for example, who can operate at much lower prices than that, but that's when some actors will start to fall out of the market. If they fell below 60, we start to see the US scaling back on investment, and that would then signal to the market there won't be as much coming from the US down the road, and that supply will be slightly restrained. Going above $70 per barrel, this is, again, where we'd see more US production coming on. So that means that lots of areas that are not kind of super cost effective become profitable, and we'll see the US coming back. Now OPEC has to balance the US price reaction, and this I think is probably the sweet spot. OPEC would like to see prices at or around 70, probably higher than that, but at $80 a barrel, then we start to see huge amounts of new production coming online from the United States, and that then sinks the price back down to this more sustainable level. The US is kind of acting like a swing producer in a way, in that they can turn the tap on and off, but it's not strategic, it's based solely on what prices are. So OPEC then, as a response, has to decide where they think the optimal level of output for their region is to make sure we don't see prices spiraling up and then tanking. Because ultimately, OPEC wants to promote investment in the oil market, and kind of extreme levels of volatility and constant up and down is not the way to attract investment.
So what does that mean for our region here in the Middle East, and in particular the GCC countries? I'm sure countries like Saudi, countries like Kuwait would like to see a higher oil price. That would allow them to make greater investments, that would allow them to turn the tap on for public spending more. So this range-bound price of between 60 and 70, is that good for this region? Is it enough?
Well, there's a big question. It will be enough for some, and it won't be enough for others. Having them range bound between that level and a stable source of oil revenue is, on the whole, beneficial for the region. It's much better than, for example, where we were in 2015-16, where prices were up and down and governments didn't know how much revenue was coming in. That inability to plan is damaging, especially for economies that are that reliant on oil. At 60 to 70, some economies will be doing quite well. The UAE is one of them. They're comfortable. It's nothing compared to the 2010-14 boom years, but still stable revenue. Saudi, on the other hand, is one of the countries that's accumulated more debt, but again, from an extremely low level before. So there's been new debt accumulation in the last couple of years. Their budget deficit has started to widen. And Saudi, at the same time, is trying to engage in these massive economic diversification plans. And it's the leader in a way of kind of setting the tone for the region. So Saudi will need more than oil at $70 a barrel, for example, to fund their economic growth schemes without accumulating even more debt. So at the moment, we think this means that the region as a whole, and especially Saudi, will stay in a fiscal deficit over the course of the next 5 years. And then as a result, we'll see debt starting to accumulate. The region can handle it. Debts are kind of globally at pretty low levels. But it does mean that as the economy of the region looks to move away from oil dependency, there'll be less revenue coming in with which to fund investment in other sectors. So slower growth and slower movement away from oil.
Thank you, Cailin. So that's the EIU oil market forecast. We are forecasting price for oil range bound between 60 and 70. There are many factors which might yet impact on that. And this is what we think the price will do for the regions of the Middle East and the GCC. So that's all from now from the Economist Corporate Network. Thank you.